If you've ever taken an accounting class, you know that all businesses are required to keep balance sheets. Banks are no different. We call their balance sheets T-charts. If you look at our T-chart for the First National Bank of Mesquite, you'll see it divided into two sections, assets and liabilities. Liabilities are what the bank owes. These are negative numbers. Assets are what the bank owns. These are positive numbers. Now, as they're called balance sheets, the main reason is because they have to balance. Assets and liabilities have to balance each other. The negatives and the positive must equal to zero. And so if we look at our First National Bank of Mesquite, let's say we decide to start this bank. And to start this bank, we first have to obviously buy some equipment. We need our teller machines and calculators, and we need our building and all those things. And so we raised $5 million in order to do this. Now, this $5 million that we spend on our plant and equipment, that is an asset because now we have a building that we own. We have teller machine, ATM machines. We have all the things we need for our bank. These are assets for our business. But at the same time, that $5 million is also a liability because these were capital investments by investors, and now they own a part of our bank. Now let's say that we get our first deposit of $100,000. The $100,000 is first going to go into our assets because now we have $100,000 cash in our bank. That is an asset that we have. But look at our T-chart. Do the two sides balance? Are they equal? No, they aren't. Well, that's because that $100,000, while it is an asset, it is also a liability. That $100,000 we have in our bank, but remember, we have to give it back to the person if they ever come back for it or if they write checks against it. These are called demand deposits. It's a bank's fancy way of saying a checking account. So when you put $100,000 in the bank, that $100,000 is an asset for the bank, but it is also a liability because if you demand your money back, they of course have to give it to you. Well, if we look at that cash, $100,000 cash, we actually need to divide this into two sections because we need to know, there's a term we need to know now. It's called a reserve ratio. The reserve ratio is the percentage amount the Federal Reserve requires all member banks to keep on reserve. When you deposit money in the bank, there's a certain percentage of that money the bank must keep on hand at all times. Now, when I say it must keep it on hand, it doesn't actually mean it has to keep it in the bank walls. It can keep it on deposit at the Federal Reserve if it likes, but it cannot lend out a certain percentage of that money. Currently, the reserve rate is about 10% for banks that have, I think it's over 45 million or something like that. We're just going to pretend it's just 10% flat. And so if the required reserve ratio is 10%, now we're going to divide our cash into two categories. Required reserves are now $10,000. That's 10% of $100,000. Now we have excess reserves of $90,000. Now excess reserves is pretty much what it implies. It's excess. It's money the bank doesn't have to keep around on a day-to-day basis. And so what is it going to do with that money? There are two options for excess reserves. The first option is to make loans with that money. So you can see that we've taken the $90,000 that was in excess reserves and we've loaned it out to other people. Okay, we've loaned it out. And when for someone to buy a house or, I don't know, a really fancy car or something like that. And so the money is moved from excess reserves into loans. It's still an asset because now people owe us that $90,000, right? And that's an asset to have someone owe you money. Demand deposit doesn't change in any way. We still have that $100,000, and so the two sides still balance. The second option that a bank can do is purchase securities from the Federal Reserve. Now, securities are basically loans that we give to the government. If you've ever wondered how the government gets all the money that it does to pay its bills, and we know that we're in a deficit, right, that we're spending more than we're earning, well, how do they do that? Well, they issue securities or government bonds. And when they do this, people buy them and they get, paid back in interest. Well, sometimes the bank may decide not to loan out all of its money, but it may decide to buy some securities. Perhaps it doesn't have enough people to lend money out to, or perhaps it wants a certain amount of security in its money, in its investments. And so, let's say the bank buys $10,000 in securities from the Federal Reserve. Well, that leaves only $80,000 for them to make loans with. Notice the total amount's $100,000, still the same. It's just differently how they've used it. Banks can also borrow money. There are two ways they can borrow money. One is called a discount window, use a discount rate, and then there's a federal funds rate. The discount rate is when they borrow money from the Federal Reserve itself. Now, the Federal Reserve is often referred to as the lender of last resort. That's because no one really wants to borrow money from the Federal Reserve if they can avoid it. When they do borrow money from the Federal Reserve, there's a lot of regulations. Plus, it's kind of like, imagine if you go to your parents on a regular basis, you start asking them for money. They may want to wonder, why do you need all this money? Why aren't you handling your money very well? Same thing with the Federal Reserve. If a bank asks the Federal Reserve for money, the Federal Reserve may say, wait a second, why do you need this money after all? And they may decide to audit them. Or if they use it too often, the Federal Reserve may just turn them down and not let them borrow it at all. When they borrow money from the Federal Reserve, the interest rate they pay is called the discount rate. So the Federal Reserve sets that. They set it at what they want. Usually, they set it just above the federal funds rate, and that's the rate the bank would pay. The federal funds rate is the rate that banks charge each other for loans. So sometimes Chase will borrow money from Bank of America, and they will pay the federal funds rate. We'll talk about this more as we get into monetary policy. But when they borrow money from the discount window or from the federal funds rate, this goes into their liabilities because now they owe $100,000. Okay, but at the same time, it goes into their excess reserves, and that money they can now lend out if they would like to. Banks may decide to borrow money because sometimes they just can't meet the required reserves and they have to borrow the money. Sometimes they would have opportunity to give out loans they feel they can earn a higher interest rate than either the discount window or discount rate or the federal funds rate, and so they'll borrow money for that reason. Usually these are very short-term loans that they get from one bank to another. Now that we know a little bit about how a T account works, we're going to learn about a multiple deposit expansion of money in our next lesson.